We are sticking with energy infrastructure here, and we have a call from Tom. He is in Edmonton. Go ahead, Tom.
Good evening, David and Mark. David, Fembina Pipeline closed at 41.76 today, which is the lowest close since April of 2014. Just to refresh your memory, their third quarter earnings came in at 20 cents, which is well below the average estimate of 30 cents, and that is the second consecutive quarterly miss. In addition, they're below their 200-day moving average of 46.39 compared to Interpipeline, which is sitting at about its 50-day moving average.
Right.
My question is, do you think that fund managers are reducing their exposure? And what do you see for Fembina Pipeline going forward? And is today's pricing a possible buy?
Right.
Thank you.
Right. So, Tom, there's lots of ways to look at things. I can only look at it through the lenses that we look through. And one of the things that I ask every day is, are things behaving the way you would expect, given what you think you know? And if you are bullish, things should be going higher in price. So this has recently been one of the weaker performers in the group. I can tell you that based on the way they've been behaving, we have reduced our position substantially in this one. You never like to see a company miss. A lot of these midstream companies have made a lot of money along the way in their marketing businesses, stripping out liquids and marketing them. So there may be a little less upside in some of the marketing businesses in the very short run. I think in the long run, this is a great industry, and it's a great industry because they're long life assets with long contracts and very little commodity exposure. In the short run, they can be impacted psychologically. That being said, it is not acting technically very well, and I would not be buying the stock here. And if I owned it, I would be looking at certainly trimming it or selling it.
Thanks for the question, Tom. Let's look at a real high flyer here in a different sector. Joe's in Hamilton. Good evening.
Good evening. My question's on Amaya Gaming. They had a target of 36. It's over 38. The new target is 44. All the governments seem to need something to help bail them out. That's semi-legal. So what are your thoughts on this company and going forward, and maybe a price? I'll listen to your answer. Thank you very much.
So we have to understand what we're looking at here. This is a company that people are buying for the future. And so there is a very large and significant upside, I think. We'll talk about that in a second. There's a business as it is today. This is a company that had about 200 different games, is selling online. They're trying to work their way into the online gaming business through their purchase of PokerStars. It is potentially an enormous market. If they can capture 10% of it, stock's way higher. So this is, in a way, it's a call on the likelihood of online gaming being legalized in various states. There's lots of risks in that. And so this is one that I think you have to understand that you take a fair bit of risk with, but there's a potential large payoff. We do have a position in the stock. It's not a huge position. It's a small position. But that being said, to your point, there is lots of reason to believe that there's a need for additional revenues at the state level, and that's not impossible. I think it's going to be a tough battle, state by state. So if anybody has a shot at it, these guys do. And so that's why we have some exposure. We like leisure and entertainment as a sector. We like the consumer. A lot of companies within this space are doing quite well. You just have to recognize that there's risk of, being impacted by bad news day.
All right, next up, Mike in Burnaby, BC. Go ahead, sir.
Hi, I'm calling about Brookfield Asset Management. It has had a good 5-year run. Do you like it, or should I look at one of those subsidiaries that seem to have higher distributions?
Sure. So this is a horse of a completely different color. Brookfield Asset Management is a highly predictable company with wonderful underlying assets. They're in the asset management business. They have lots of different types of assets that they manage. It's fee revenue that they generate. They have had a great history of continuing to build assets. It's a very global business. About 40% of their business is in the US, 20% Canada, 20% in Australia. I think that there is great visibility in the fee revenue that they generate going forward. And management's had a great record of allocating capital. So this is not an exciting company, but it's one that I think you could expect to continue to see dividend growth in. They like to reinvest most of the capital, so it's not a big dividend stock. But it's a long-lived asset with great predictability and should grow very steadily. This could be a core position in almost any portfolio.
Do you hold this one?
We own this one.
And what about some of the other Brookfields?
We own this one. Some of the other Brookfields are a little more problematic as far as taxes go and so on. So this is our focus.
Okay. Ernie is in Mississauga. Hello there, Ernie. Good evening.
Hi, Mark. I really enjoy your show.
Great.
I was just wondering what David's opinion on Bank of America is. I thought the lawsuits were behind them, but it seems like there's some foreign exchange manipulation things going on. But I still really like the stock and like to know David's opinion. Thank you for taking my call.
Yeah, in general, the politicians are pretty good at jumping on the bandwagon when they don't like an industry, and certainly, this is one that's gone through the mill over the last few years. But you're not looking backwards, you're looking forwards. And the U.S. banks did a great job in recapitalizing their balance sheets. In other words, raising capital, putting themselves on a good footing to grow going forward. Something that the European banks did not do, as we saw recently when we saw the stress tests. So we've worked our way through all these lawsuits. U.S. economy is slowly and steadily getting better. Bank of America is getting slowly and steadily better along with it. I think that there is and continues to be outsized opportunity for dividend growth. I think dividend grew 400% in the last year. I don't think we're going to see that every year, but I think you will see above average dividend growth rate going forward. So we own the stock, and I think that if you think the market is on good footing, and we do, we see money getting put to work, and if you think valuations are reasonable, this is likely to perform well. If we start to see the financials underperform, we look to reduce our exposure, but they are performing in line or ahead of market, and this is one of the better performers. So we like this. We like Wells Fargo. We like the asset managers. We like the life cos, but we do see accelerated dividend growth going forward.
Hypothetically, could you see a double on this stock in, say, 2 or 3 years?
There's no reason why you couldn't see that. You look at the fact that they have pretty good capital markets business, and capital markets are getting better. It's interesting. Since 1928, there have been 21 midterm election cycles, and in all 21 cases, market was higher a year later. An average of 30% was the return in the following year. So we've just gone through a midterm election. We see improving markets. We see growing dividends. Dividends growth in the S&P this year will be in the low teens. It was 6.8% last year. We think it'll be higher again next year. Dividend payouts are only about 35% of earnings against a long-run average of 50% of earnings. So dividend growth coming out of financials is likely to be well ahead of long-term trend, and that will be favorable to a baby boomer who's looking for income replacement.
Okay, David, pause here, and we'll get back to questions after this.